Hi, I'm Brien Lundin, and I'd like to welcome you to the third and final session today, the third block of the Metals Investor Forum. We have a presentation from me to begin. I edit and publish Gold Newsletter, as many of you know, and we also have 4 wonderful companies coming up that are recommended in Gold Newsletter after my presentation. And what I'd like to do here is get you started on my views and what's going on in the gold market. As you can see from my opening slide, there is a new metals bull market in progress. That's no surprise to anyone involved in this sector, and I doubt there is any surprise as to why. But just in case, we'll progress and go over that a bit. The COVID-19 pandemic, of course, was the pin that pricked a massive existing bubble. That's my thesis, at least. I believe that where we were going to see some central bank intervention, we were going to see a return to easier money policies at some point this year, most likely in the relative near future, because these bubbles had reached a certain point where they needed to be fed more easy money policies. And so all of this was going to happen anyway. But the COVID-19 pandemic came, and it was the catalyst. It was the pin that popped the bubble. It happened a bit earlier than I thought it would happen, but it did happen, and we're living with it now. And the economic repercussions have been extraordinary, nothing short of extraordinary. As you can see from this chart, we have the April, the unemployment numbers that just came out of well over 14%, almost 15%. And this exceeds anything we've seen in recent history. This is depression level unemployment rates, and it was immediate. It was a total shock to the U.S. and global economies. And that's what we're talking about right now. That's what we're assimilating. Again, if you look back in the 2008 crisis, about 10% unemployment rate where that peaked, and we exceeded that very quickly in this instance. Now, the policy response to all of this was immediate, and it dwarfed anything seen before. Not just in degree. I fully expected we were going to see a lot of what we're seeing now, but over the span of, say, 3 to 5 years. Instead, it came over the span of, in some cases, 3 to 5 days, but certainly over the span of a few weeks. Initially, what the Fed did was start quantitative easing right away, and once again. Now, if you remember, post-2008 in the great financial crisis, they did QE1, which didn't become QE1 until they had QE2. And then they had QE3, which was, of course, at that time, unlimited quantitative easing. In this case, they went and immediately leaped to quantitative easing on an unlimited basis, QE infinity. This chart is very interesting in that you can see that gray shaded area. That was the unwind. That was the Fed trying to normalize its balance sheet. That in that process, lasting not quite 2 years, the Fed was able to unwind about $679 billion off of its balance sheet. And that, of course, is the line you see going down in the gray area. But then end of last August, the Fed started kind of quietly, but began buying again. They didn't call it quantitative easing because it didn't go across the entire rate curve, but it was, in fact, quantitative easing and recognized as such by investors in the market. And that's where you see this kind of gradual line going up. Then, of course, you have the COVID crisis, just shot off like a rocket. To where we are dwarfing, again, previous record levels on the Fed balance sheet. Now, if you look up here, you'll see that the change last week was $65 billion of Fed asset purchases. Now, when they initially started these programs in late March and early April, for this first couple of weeks, they were buying at the rate of over $500 billion a week. So this looks like they've really moderated things to $65.9 billion. And as you can see at the top of this line, it's kind of leveled off a bit. But it serves to remember that this level of buying per week of over $60 to $70 billion, that's higher than the Fed was buying per month in its previous instances of quantitative easing. So really, even at this throttled back, and I think temporarily throttled back level, we're still talking about rates of asset purchases that are 4 times anything we saw in the previous financial crisis. So the Fed's QE infinity, which is what we were just looking at in the previous chart, that was immediately supplemented by trillions in stimulus spending, including helicopter money directly deposited in voters' bank accounts. They didn't need helicopters. They just directly deposited money in voters' banking accounts. Massive helicopter money, massive easing, massive spending. And the result of that is what we see here. The U.S. national debt is now at $20.2 trillion. Now, it was only just a few weeks ago or a couple of months ago when in my newsletter, in Gold Newsletter, I was talking about how the U.S. federal debt was already out of control at about 22.5, close to 23 trillion. Now it's already 25.2 trillion. And I did this chart use this same chart in a presentation last week, and I just updated it literally this morning for this presentation, and noticed that the federal debt is up 177 billion in just that week. And the debt to GDP down here, right, is up a full percentage point over the last week. That number was hovering around 104, 105% for nearly a decade. Now we're up at 118%, and it was 117% last week. It's important to also realize that for that number, the debt is growing using old GDP numbers, and GDP is actually going to drop significantly this year. So that number is just going to absolutely soar in its next updating of the GDP. So what are the implications of this? The implications, quite frankly, of such a large federal debt and debts in general are for interest rates. Now, the second arrow that the Fed or that the government employed, or actually that the Fed employed, in addition to quantitative easing, was interest rate reductions. They immediately brought interest rates right back to zero. I mean, they weren't messing around. They shot the bazookas right out the gate, brought interest rates right back down to zero. Now, if you see this chart, shows the Fed funds rate going back to essentially 1980. And as you can see, the central bank, in every economic slowdown or crisis of any sort, would resort to interest rate cuts to mitigate the effects. So we never really got the kind of cathartic cleansing of the boom-bust cycle. We never got the real bust. We never got the beneficial effects of recessions, and that the excesses. Instead, the Fed would ease money, lower interest rates to try and soften the blow. But as we know, the end result of that would be that they would blow up new bubbles. But what you can see here is that every bottom in this process is lower than the previous bottom. Now, every drop in interest rates, when they would try to normalize rates after every economic slowdown, never reached the levels or previous levels or previous tops. So it was just a stair step down in each process. Each cycle, each boom bust, rates would end up lower and lower until post-2008, as we can see here, we ended up at zero. Now, where are we now? We're at zero again. The next step is into the basement. We've taken the stairs all the way down to the foundation. We've opened the door to the basement, and the next step we take is going to be or negative interest rates. Now, we've heard a lot about that lately. We've heard Fed Chairman Powell in a speech just yesterday or the day before talk about how the effects of negative interest rates are mixed. Something that the Federal Reserve is not contemplating right now. Everybody's spoken up against it, but frankly, I thought his remarks weren't quite as dismissive of negative rates as one would like to see. And he did leave the door open a crack. I'm not saying we're going to have a negative funds rate, but I will say that the futures markets are pricing about a 25% chance of that before the end of the year. And this is the pattern. The next step is to negative interest rates. So what do negative interest rates mean for us? In addition to all the other distortions of the economy, what do they mean for metals investors? Well, gold loves negative rates. And this is a wonderful chart from our friends at Incrementum who do the In Gold We Trust report, the annual report. And as you can see, the blue shaded areas are periods of negative interest rates. And this gold line is the gold price. And when we have periods of generally negative real rates, and I should specify that when I'm talking about negative rates in this context, I'm talking about negative real rates adjusted for inflation, not just nominal rates as a negative Fed funds rate. So we are already in a period of negative real rates adjusted for inflation. And again, gold does very well during periods like this. These blue shaded areas, we see tremendous strength in gold in general during a period of negative real rates. Now, my contention, my theory here is that we are not only in a period of negative real rates, but that our federal debt is now so large that we can never have positive real rates again. Otherwise, the cost to service that debt would just crush the federal budget. So as far as the eye can see, or at least under this current monetary regime, we are going to have negative real rates. And this is enormously bullish for precious metals. So let's take a look at comparing the 2008 financial crisis for gold in this case with today. During the 2008 crisis, as we can see, there was tremendous volatility. This is a kind of liquidity-driven sell-off that we saw both in 2008 and most recently in March in the gold market. When investors and speculators had to raise cash, they broke open the golden piggy bank, sold gold, and that's where we see these tremendous drops. Yet investors and speculators also see the policy response coming up and they buy gold. So we have big surges up and big sell-offs down, and then it starts to stabilize. So what happens eventually, and what happened eventually after the 2008 crisis, especially as the Fed came in with these policy responses and the fiscal stimulus programs, was that investors all kind of got on board the gold train. And here we see that from the lows of around $700 in the depth of the 2008 crisis to the peaks beyond this chart in 2011, gold essentially more than doubled and essentially tripled in price. Or close to tripled in price in the aftermath. That was a tremendous run in gold. It was a kind of move that I think we have coming up ahead of us as we enter this new bull market, and as these policy responses get to be appreciated by investors, by the markets. Right now, we're at this early stage. We're having a nice run up, but this is the kind of thing I'm looking at. I think we have a very powerful long-term bull market facing us right now. So let's drill down a bit. Let's look at what the metals are doing in this crisis. First, this is another long-term chart. It's a stochastic. I like to look at this as a momentum indicator, but this is a very long-term 14-month stochastic. It shows broad sweeps in the market. I just want to bring your attention to the end of the 2000s, actually the end of the 1990s and the early 2000s. We had essentially a triple bottoms. We had an initial rise, and then we had another final drop, and then we went up, and we had a long-term period throughout the early 2000s of sustained upward momentum on this long-term stochastic in gold. And if we look back here, we've had a similar thing going out of this bear market. We had one drop. We bottomed in 2015. We had a nice rise in 2016. And then we had another drop back in 2018. And now we're off again in this long-term stochastic. So very similar pattern to what we had at the end of the 1990s and early 2000s. And what remains to be seen is, are we going to have this kind of a long-term upward sustained momentum like we had in the early 2000s. Drilling down a bit, gold, this is a 3-month chart. We see that we had this great run in early April, and then we've been kind of digesting it a bit. And building a pennant or flag pattern here of decreasing volatility. And what this shows is that we're expecting an imminent breakout of this pattern to the upside. In fact, I did this chart last night, and that may have happened today. Gold was up nearly 1% up to the 1730s level. So we may have broken out of this pattern today. This may be forecasting or presaging a nice run ahead of us right now. Looking closer in, the 14-week stochastic for gold we had an initial downturn, as you can see here. That was kind of the March sell-off, and yet we never got much lower, and we rebounded. And what's important here is that you see long rounded tops, that we spend some time around that 80 level or above. When we had that in the early 2000s, even going into 2011, we had tremendous runs in gold, tremendous runs in the junior mining stocks. And we're getting that, hopefully that kind of pattern right now, because gold didn't settle back to the lower levels. It reversed course very quickly. We see a similar pattern in silver, off more dramatically, as you can see on the end of the stochastic, much more dramatically than gold. We expect that, and it's lagging gold, and we expect that as well. It is just turning up on that stochastic and starting higher now and playing catch up. That's one of the reasons why I like silver a lot at these levels. Copper, as you can see at the bottom of this stochastic, has started to show again that it has bottomed and is showing upward momentum. I think the timing is a little more critical with copper, but importantly, it shows that at least in the near term, we have bottomed and turned higher on copper. I want to touch on palladium and the PGMs a bit, partially because we have a great PGM company, exploration company, on our panel today. But if you look at this is gold palladium ratio, and this down sweep in the line last year was that tremendous palladium bull run that we had when palladium was outperforming gold. And then since then, through this crisis and through the initial stages of this bull market, as the policy responses are being appreciated again by the market, we've had gold reverse that trend and start to outperform palladium. If you look at the very tail end here, you can see that line has started back down again, and palladium has once again begun to outperform gold. Now, I don't look at palladium as a monetary metal like gold and silver, or at least not nearly to that degree, but there are some fundamental factors, supply-demand factors, that are driving palladium, and I'm very bullish on the palladium and platinum prices going forward. All of this has resulted in a global rush into gold, and this is not a long enough chart for you to see the previous highs in the gold ETFs, but this is a chart from our friends at Gold Charts R Us, or Share Links. Great chart service, by the way. And it shows all of the transparent ETFs, all of the published repositories, gold, physical gold, mutual funds, and ETFs. And as you can see, we've had a tremendous surge here to new record heights. And this has happened as we've also seen open interest kind of collapse on the COMEX in paper gold and paper silver. And what I think we're seeing is some of this uncertainty in the paper gold markets as far as security of supplies backing those contracts. I think we've seen a lot of investors, some big ticketed institutions, big pocketed investors, moving more into the physical ETFs as opposed to the leveraged paper gold markets. Now, finally, what I'd like to do is stress where we are in this cycle. We are well over $1,700 on the gold price right now. But if we look back at the inflation-adjusted historic gold price, if we look back, for instance, in 1980, and that nominal price back then was $850. In today's dollars, to equal that, to reach that prior peak, gold would have to get up to $2,820. So we're a good ways away from equaling or breaking records on the gold price. Even the 2011 record of $1,900, $1,920 or so we'd have to get to 21.55 to equal that in today's dollars. So we're in not just the early innings, we're in the initial inning of this gold bull market. I think we're easily going to get into the 2000s over the next year or so. And the result of that in these junior mining stocks is just going to be extraordinary. The levels we see now, the basic levels of these stocks, the 10, 15, 30 cent stocks that we're looking at now are going to be all selling for well over $1 to $2. That's going to be the kind of market environment we're going to be in. So you have not missed a boat. We are in the first inning of this game, and it's time to get involved. This is me, goldnewsletter.com, NewOrleansInvestmentConference.com, NewOrleansConference.com, being held this year, October 14th to 17th. And you can find me on Twitter at Brien_Lundin. You can go to goldnewsletter.com /report to get our free investor's guide to gold and silver.